Hey, everybody. Welcome to the morning market briefing. It's Tuesday, June 30th, 2026. Quick reminder, no call on Friday, July 3rd, but for now, it is the last day of the quarter. I think it'll be a relatively busy day, but we're going to open up with Lisa Cook. Tom, we've talked about Lisa Cook, the multiple primary residences, the potential mortgage fraud. Supreme Court has come back and said, hey, you can't just give her the boot without cause. The decision was quite narrow, and there may still be cause to come.
Yeah, it's interesting because yesterday was a real changing of the guard from a Fed watching standpoint. As someone who is a Fed watcher,
Watch the Watchmen.
Almost professionally, there's a lot to be taken away by the two major articles that were written yesterday. So Nick Timmerhouse, who for a long time has been Jay Powell's, let's call him butt buddy, put out a long think piece about how this was never really about Lisa Cook's obvious fraud and by the letter of the law, criminal act of mortgage fraud. It was about protecting the beautiful
the
independence of the Fed and the true noble nature of her position as the least intelligent person on the Fed voting committee.
We must protect that role.
On the other hand, you had the New York Times put out a really, I would say probably the most solid Fed piece I've read in a long time, talking about Kevin Warsh, sort of what he's been doing behind the scenes of the Fed, how he's addressed what he thinks the Fed's mission is internally, what the tightrope is that he has to walk in order to get, the data that he thinks is important brought to the forefront to get across his way of thinking about the balance sheet, thinking about raising and lowering interest rates and how the market kind of corrects itself. So that was actually written by Colby Smith. So I'm going to preface this by all due respect to my wife, but when you watch the Fed stuff, it's a real who's who of fattos and Uggies in there. There's a lot of unattractive journalists who just...
I'm not sure what this has to do with Maeve. I just want to make that
I'm just saying,
early and often.
I will say the highlight oftentimes is a girl, Colby Smith, who on a normal scale is, I would call her a solid 6.5, but by Fed Watcher scale, yeah, you're like, whoa, because she puts a little makeup on. She asks good questions. I will say that in preparation for her becoming the new Fed Whisperer, they changed her profile picture on the New York Times, and it looks like she's auditioning to be the girl who comes out of the TV from The Ring. It's just crazy. That's her professional photo now. But I think they probably did that on purpose just to make sure that she fits in with the other people who ask questions at the Fed, press conferences. But I thought it was great. It's been a long time since we read an interesting, thoughtful piece on the Fed that was sort of, I would argue, I hate to throw this out here, but fair and balanced, talking about, there's a lot of upsides and downsides to how he's attacking this, changing the precedent, perhaps changing how the Fed operates. And it didn't have anything to do with worshiping the Fed or worshiping the Fed chairman, which I thought was surprising from the New York Times, honestly. And it's just a stark contrast to crybaby Nicky Timmerhouse, who's just sad because he's definitely getting fed crybaby stories from Jay Powell, who's still walking around the halls of the Fed that cost us $4 billion or whatever. So I would expect that to be the cadence going forward. Is one side is going to be pretty interesting, the other side is going to be Nick Timmerhouse. So
tough day for Nick. This has to be tough for him. I can only imagine another book is going to come out of this. My Fight for Fed Independence.
Yeah,
something like that.
There was a lot of changing the guard yesterday too. So one is Timmerhouse actually came out with a video accompanying his article yesterday.
That's a new thing. Have you? Michael Schellenberger does that,
yes,
where he puts an article out and then he reads it very dryly into his Twitter feed.
Yeah, here's an audio book of this article.
Yeah, it's very interesting. Yeah, it's strange.
So, I guess the upshot from Lisa's perspective is that she keeps her job for now, but if they can prove that she was, fraudulent in what she did, and that's the thing, I don't think they've proven it yet and proved her guilt, but if they did, it seems like that could be construed as cause.
My question is how
How have they not proved it?
Not proved it, yeah. Like if I had a condo in Kansas City that I rented out but claimed as my primary residence, that's really all the information you need to know because I don't live in Kansas City. And that's how mortgage fraud works.
It seems harder to prove that you do live in Kansas City than to prove that you don't.
I drove through there one time.
Yeah.
And not recently.
The other piece yesterday was an interview between Joe Kernan and Jeremy Grantham.
Oh, so good.
Which was really rough. And it was doing the rounds on Twitter as well. And basically Jeremy Grantham's been calling for a bust for the last
as long as I've
50 years.
And, he's been temporarily right a couple times.
Yes. And then Joe Kernan asked him, we were at 2,500 on the 2,300 of the S&P 500 in 2021. Since then, the market's up 3x. Have you once said that stocks are a buy? And then there was this long
dusty pause.
Yeah, with no response. And Kernan basically says, yeah, that basically answers my question.
Yeah.
This wasn't my interview. Andrew Ross Sorkin booked it, so you can ask the questions.
Yeah, Kernan's gotten a little feisty lately. I like it.
Jeremy Grantham looks like he came out of central casting for the mean old grandmother in a horror movie.
Yeah, he is.
If you put a wig on him, you'd be like, oh, no, that's the bad guy.
Certainly one of the... Have you guys heard him speak before?
Oh, yeah.
It's rough. It's really like, what are we doing here? I thought this was about investing.
I mean, he kind of sounds like the mean old lady.
Yeah.
And maybe a goat, like if she had a child with a goat.
He gets invited to all the conferences, though. He spoke at the Schwab conference.
People love him. Like, and the most bummer investors I know are the biggest Jeremy Grantham fans.
Yeah.
Because you'd be like, hey, man, this is going pretty well. And they're like, well, did you see that article from Jeremy Grantham where he said that everything's going to zero again? You're like, yeah. No, I've read that one a few times.
For decades.
Yeah.
Meanwhile, maybe on his page, Citi and Bank of America thinking we're at the top.
Yeah, I wanted to bring this up because I think that there's a lot. This is going to get headlines because it always does when these big investment banks call the top. But there are so many divisions within each investment bank. So for just Citi, in the last 36 hours, you have the headline: Citi says pressure is building on the Nasdaq and S&P 500. Says that approximately 80% of long positions face being underwater right now, which seems a little bit crazy to me in the Nasdaq 100 that there would be that many people with losses. This says concerns over AI valuations have.
How did they phrase that, Ben? 80%?
80% of current long positions are underwater.
Are underwater?
Yes. Downside risk due to excessive positioning and approximately 80% of long positions being underwater.
There's no way.
Yeah.
I mean, unless you only own Microsoft.
But to be there, you would have to imply that the market-wide turnover is everyone
every day
sold everything
and bought everything in May. Yeah,
and it's like if the market's up today, 100% will be up.
Yep. Then also says concerns over AI valuations, that fact that hedge funds are reducing their exposure, and also bearish fund flows in both the Nasdaq and the S&P 500 as capital shifts towards the Russell 2000. But they also say that the year-end price target is 8,100 on the S&P 500, which is 10% above the current levels. And they also said yesterday that, and this is from their Citi Wealth Management arm, so this is who are advising clients, they said, you got to put cash to work because inflation is hot. So there's too much money on the sidelines. You got to get that working. You got to put that in, buy some stock. So there's definite lack of unity there. And I think that we've seen this at times from Goldman as well. You have a private wealth division, and then you have the investment bank, and then you have the economic strategist, and they're all saying different things. So guaranteed one of them is going to be right.
I also think there's an element of this where this is a lot like the casino in a sports betting scenario, where what I really want is equal money on both sides of the bet, because then I scrape the big from both sides. One side wins, one side loses, but I made money. With these big banks, there is an element of we kind of need market participants through the various channels that we have to do a little bit of everything. And that's how you get there.
Yep. And then Bank of America has also said that on a technical basis, things are correcting. I couldn't see the full report, but apparently, and I've never heard this phrase before, but he says there's going to be a triple correction in the next couple months that would take us down 10% from where we currently are. A triple. So I don't know.
So
if that,
three,
boom, boom, boom.
yeah, like a.
So we're going to fix it, then we're going to unfix it, and then we're going to fix it again. That's what I'm hearing.
So is that 3 troughs or 2?
I don't know. That's I've never heard the phrase, but he says that's the tail risk case of taking us down 10%. The base case is a double correction. So,
man,
I had the Jeremy Grantham that one. Long pause as I tried to understand that.
Yeah.
I would say I think that, you know, when we, and Hakes, maybe you can put this chart up. I do think that there is some point to the concerns as we go into Q3. You have midterm elections. You have IPOs that are sucking a lot of money out of the market. And things we've talked about for a while. You have the hangover from the World Cup, the pull forwards, all of these things. And I wrote about it in the market memo on Friday. So I think there is some element to think that, yes, you could see a little bit of a pullback here in Q3, and that wouldn't be surprising, and I think we'd probably be taking advantage of that. And so it's the type of thing that you got to get prepared for ahead of time. I don't think this is going to be a massive crash, but I do think they bring up some good points. I would also say, though, sentiment is not excessively stretched. I think you read those articles from Bank of America and Citigroup, and you think that, man, everyone is on one side of the boat, and that's not really the case. I would say that investor sentiment and positioning is more like a 7 out of 10. It's elevated, but not extreme, and so I don't think that we're set up for a massive crash like some.
This is a random question that I did not give either of you time to prep on, but we talk a lot about politics in the office on the call when necessary, but specifically like net favorability ratings, approval ratings, whatever it may be. And we've gotten to a place where politically, I think everyone would accept the fact that like really the ceiling for a national candidate's approval is basically 50%. Within their party, it can be higher, but across both parties and independents, 50% is certainly a ceiling, which frankly just was not the case 20 years ago. I wonder if we might not be experiencing a bit of a shift where people have become so polarized on everything, and I think politics maybe plays a outsized role in their thinking on this. But when you think about the frothiness of a market, and you think about kind of the general sense of euphoria from investors where all we can do is make money, it's only going up, this is so easy. I wonder if that has not also been eroded to where, to your point, hey, sentiment feels like it's a 7 out of 10. On this new adjusted scale, is that actually a little higher than maybe we would have seen 15 years ago?
Yeah, I mean, I think maybe.
Yeah, and I don't know, but I'm curious.
Yeah, so I looked back at like the last 5 years of data, for example, and that's kind of where I came out of. I just looked at the AAII survey, institutional investor survey. I looked at the put call ratio of where options are being bought, and that's kind of my very qualitative measure of that. I don't know historically how that's trending, you know, if I look back 20 years.
Yeah.
But in the last 5 years, I would say that's probably about fair. I also think that I think you bring up a great point, though, in that there are a lot of people who are concerned about heightened volatility in the market, where the market moves up 1% or down 1% in any given day, or even 1.5%. And I would actually say, you know, if that's a sustained environment, that's probably a lot more healthy than what we saw in 2014 or 2015 or 2016. And, you know, when you had those, or even 2020, 21, where everything just went up by 0.5% every single day. And this gets back to Leb's point of you'd rather have lots of controllable volatility and allow that to take place rather than try to immunize against that, and then you have the crash, the big crash, because otherwise it just builds.
I mean, it's also the concentration of names that are up so much recently to drive this are pretty easy to avoid. So if you think, oh, Micron's overvalued here, then don't own Micron.
Yeah.
And you can avoid the crash because something that goes up 60% in a month is experiencing insane standard deviation, which means it could very easily come back down 40% in a month. I mean, almost instantly. And so the splintering of the market right now is so interesting because, like Microsoft continues to make more and more and more money. I mean, that's been the net biggest drag on our portfolios just by being one of the best stocks to ever have IPO'd. And there's things like Micron, which we've owned on and off in the past, and for the most part has been a real drag because it never makes any money, and then suddenly they make a ton of money. And so it's this weird dichotomy where you've got a lot of high-quality companies that are underperforming, a lot of previously low-quality companies that are outperforming, and they're very easy not to own. And so I think that sort of is deceiving because there are a lot of things that are up. Intel's up a ton. SanDisk, Glowworm, Corningware, which is the glass company we've talked about a bunch in this podcast, used to be an all-time value trap. I've owned it. You've owned it. We've all thought about, man, if this thing could really figure it out, they pay a huge dividend, they could go somewhere. It was up, 20% yesterday because, they're benefiting from all of the, glass derivative products that go into these chips. And it's like, well, when is that going to run out? Because that was just an absolute, I was going to use profanity there, turd of a company.
You've gone from 14 times earnings to 45 times earnings on that company.
And the thing on the chip side, specifically thinking about memory, do we know when this cycle ends? No. We know it does, and we know it's real painful when you're there. And unlike Grantham, where we're not sitting here saying this is the top of the market, everything's going to zero, it's a little easier to say, you know what, I'm not going to chase Micron.
Because I can tell you, and you can take this to the bank, Micron is not going to earn 80% gross margins for a long period of time.
No.
Yeah, they're not NVIDIA.
There's already threats.
Yes.
NVIDIA is selling a highly nuanced product that they can only create, and Micron is taking advantage of a supply constraint.
And NVIDIA only makes 70% gross margin.
Yeah.
It's crazy.
And they don't really make anything. Taiwan Semiconductor makes it.
Yeah. NVIDIA thinks about making
they make ideas.
Yeah. Idea factory. All right. We'll wrap it up there. You guys have a great day. We'll be back tomorrow morning, and we will talk to you soon.